So we are doing ratio analysis. We just revise and recall all the videos. We have three efficiency ratios: inventory turnover ratio, trade receivable turnover ratio, and trade payable turnover ratios. Whenever you have turnover ratios, okay, you will have the sales or purchases in the denominator if your answer is in days. Okay. So if you have
Yeah.
inventory turnover ratio, it's average inventory over cost of sales. Trade receivable turnover ratio, it would be trade receivables over credit sales, and trade payable turnover ratio, trade payables over credit purchases. Can
Hmm.
you tell me what does the inventory turnover ratio tell you?
That how many in how many days your inventory can be turned over? Like how much?
It can be turned into cash or into
Yeah.
sales. Trade
Hmm.
receivable turnover ratio
How many days your customer is going to pay you in?
and trade payables turnover ratio.
The credit period you have to pay your suppliers.
Okay, then you have your working capital cycle ratio. Okay, it tells us whether your business is in danger of over trading. Now, what is over trading? For this, you need to watch a video. When you're trading too much, but you don't have the money to hold your liquidity position. Okay,
Okay. Hmm.
okay. So, when I talk about the working capital cycle ratio, you do your inventory turnover ratio plus the trade receivable turnover ratio minus trade payable turnover ratio.
Okay.
Okay. When working capital cycle ratio tells you the cycle of receiving the money minus paying the money. So the
Yeah.
shorter working capital cycle ratio you have, the better you are completing your entire cycle. When I
Huh.
say the better you're completing your entire cycle means what?
The faster you're going to get.
The faster you're going to sell, the faster
Yeah.
you're going to receive the payments, and the faster you're going to pay the payments. Okay.
Okay.
So when I
Hmm.
talk about working capital cycle, so your entire cycle of selling, receiving minus paying, the shorter it is, the better it is.
Yeah.
Okay. This is in days. So working capital cycle ratio shorter, the better.
Got it.
Okay. Now,
Yeah.
there are some examples where you have to calculate your working capital cycle ratio. I will give you time to solve this before and after changes, then you can do that. Let's
Yeah.
recall
Okay.
your profitability ratios.
Okay. So, the gross profit margin is gross profit upon revenue into 100. Then there is markup, which is gross profit upon cost of sales into 100.
Okay, can you tell me what does this help you to do?
This helps to find the gross profit.
It helps to find the gross profit. Profit margin,
Profit margin is profit for the year upon revenue into 100.
then return on capital employed.
Return on capital employed is 1 minute. Capital employed upon non-current liability minus
It is
this, na?
profit from operations over capital employed into 100.
Okay, sorry.
What
Huh.
is the meaning of capital employed?
That if the money you're giving in the business, are you getting it back?
Money used in the business.
Yeah.
How do you calculate capital employed?
Profit from operations upon capital employed into 100.
This is return on capital employed. But how do you calculate capital employed?
Capital employed is non-current liabilities minus current liabilities, right?
Plus owners' funds or shareholders' funds.
Oh,
So
okay.
it could be total assets minus current liability or total liabilities minus current liabilities, or you can add just the capital and non-current liabilities.
Oh, okay, fine.
Okay. What is your expense to revenue ratio?
Expense to revenue ratio is expenses upon revenue into 100.
And operating expense to revenue?
Operating expense upon revenue into 100.
Okay, very well. What are your liquidity ratios?
Current ratio and asset test ratio.
What is your current ratio?
Current assets upon current liabilities.
Asset tests?
Asset test is current assets minus closing inventory upon current liabilities.
Ideal current ratio,
1:1.
2:1.
Isn't that asset test ratio के लिए?
Asset test ratio is 1:1.
Oh, okay, I got confused. Your
Okay,
screen is not showing anymore.
no problem. Ideal current ratio.
Ideal current ratio is 2:1 and asset test ratio is 1:1.
Okay, fine. So can you tell me your ideal current ratio
Ideal current ratio is 2:1.
and ideal asset test ratio?
1:1.
Now let's talk about efficiency ratio. Efficiency ratio tells you how quick you are in either collecting money from your trade receivables or paying to your trade payables. And there is one new efficiency ratio which was there in AS and it's added. I don't know if you remember your AS ratios or no, but this is a new efficiency ratio, that is non-current asset turnover ratios. One thing here you
Okay.
need to remember, that whenever there are turnover ratios, your sales, it will help you to find your sales. With me?
Okay.
Now, trade
Yeah.
receivable turnover ratio, can you give me the formula?
Trade receivable upon credit sales into 365 days.
Okay. And how about trade payable turnover ratio?
Trade payable upon credit sales into 365.
No, for trade payables, you will use your credit purchases and not your credit
Oh,
sales.
sorry. Yeah.
Inventory turnover ratio?
Inventory turnover ratio is cost of sales upon average inventory into
See,
100.
whenever you're doing anything in days, the name that comes first will be in the numerator, the name that comes later will be in the denominator.
So average inventory. So what? 1 minute. Name that comes first, numerator. Okay. So it will be cost of sales upon average inventory into
If your
365.
answer is in days,
Okay.
okay? So
Hmm.
inventory on top, cost of sales down into 365.
Yeah.
So if your answer is in days, you follow the straight formula. What is first is in the numerator, what is last is in the denominator.
Denominator. Okay.
Okay? But if your answer is in times, you just turn over your ratio.
Okay.
Okay. Now, if you see net current assets turnover ratio, can you see this ratio?
Yeah. Net current assets turnover ratio.
So you are going to turn, if your answer is in times, okay, TT, you turn over your ratio. So the
Hmm.
turnover would come on top and the net book value of your non-current assets would come down.
Yeah. Okay.
Okay, so turnover would be on the top. The net book value of your non-current assets will be down. What does this ratio is telling you? This ratio is telling you how efficiently you're using your non-current assets to
Okay.
generate revenue.
Hmm.
Okay, so how efficiently you're using your non-current assets to generate revenue. This is your efficiency ratio, that is non-current asset turnover ratio. Are you with me?
Yeah, I got it.
Okay, very well. Go ahead. Now, new ratios, it's only for A levels. Solvency ratio and investment ratios, these are the new ratios that you have to learn. Working
Hmm.
capital cycle ratio. That means you're selling your inventory, collecting money, and then paying. So, all this is going to take you how many number of days is your working capital cycle ratio? Okay, so it's a
Okay.
trade receivable turnover ratio plus inventory turnover ratio minus your trade payable turnover ratio. The shorter time you're taking to convert to finish your entire cycle, selling, receiving, and paying, the better you are.
Hmm.
Net working assets to revenue ratio. What does this tell you?
Net working assets to revenue ratio is like how much your current working assets are giving how much back to you.
Your working assets is generating how much sales?
Yeah.
In net working assets, what are the form? What is the formula?
Inventories per trade receivables minus trade payables.
Remember, in working capital cycle,
Same formula.
days, you're going to use days. That means you're going to use the formula for days.
Okay.
But over here, you're going to do your net working assets.
Okay.
Okay. Now your interest coverage ratio. What is interest coverage ratio? your interest expense. Okay, you have interest expense that is on your fixed cost capital. You
Yeah.
might have interest on loan, interest on debentures.
Huh.
So when I am talking about the interest coverage ratio, my profits can pay my interest how many times?
Acha, okay.
Okay, so when somebody is giving you loan, they will see your interest coverage ratio. They would try to see that how capable you are to pay your interest. If your profit can pay your interest 10, 12, 13, 14 times, okay, you are capable. If your profit is like 100 crore and your interest is 1000,
Then you're capable, no?
more than capable.
Yeah.
Interest coverage ratio, any coverage ratio tells you how capable you are to cover that expense.
Miss, I have a question on this. Miss, for example, if my profit is like 50,000 rupees and
Hmm.
my interest is 5,000 per year, okay,
Hmm. That means you can take 10 times.
10 times. So that's good. They'll give me a loan.
Good, yeah. They
Yeah,
will
okay.
give you a loan. But
Hmm.
if your profit is exactly equal to your interest expense, nobody is going to give you a loan.
Yeah, okay, fine.
Okay. Now we go to the gearing ratio. Okay. What is gearing ratio? It is your fixed cost capital.
Hmm.
Fixed cost capital, that means capital that is going to take a fixed amount of interest, which is your non-current liability. So
Yeah.
another name for your non-current liability is fixed cost capital. Which ratio we're talking about? Gearing ratio. So gearing ratio is basically your fixed cost capital divided by your total capital. Now understand the meaning of gearing. Okay. This is your total capital.
Okay.
Hello. Total
Yeah.
capital means your own funds and your loan funds. Loan funds is called non-current liability. Loan
Yeah.
funds is also called the fixed cost capital.
Yeah.
Okay.
Hmm.
If in your total capital, your own money is more and the money that you borrow is less. Okay.
Okay.
That means you are dependent on yourself more and you're dependent on others less.
Yeah.
Yeah. You are running your business with your own money.
So then I'm dependent on myself more.
You're dependent on yourself more. In
Yeah.
this case, your non-current liability will be little less and your denominator will be more because your own funds is more.
So that's good. Yeah.
So that is good. Your gearing will be less.
Okay.
Okay, gearing will be less. That means your creditors are not surrounding you to
Okay.
take back their money. Your gearing is less.
Yeah.
So gearing tells you that are you dependent on outsiders more or are you dependent on your own self more. So if
Ah,
your
okay, fine.
numerator is less, if your loan is less, your gearing is less. But if your
Okay.
loan is more, that means your total capital is made up of more of loans.
Hmm.
What is the other name for loans?
Non-current liability.
What is the other name for it? Fixed
Um.
cost capital.
Sorry, fixed cost capital.
So if your fixed cost capital, your loans or your non-current liability is more, that means your numerator will be more.
Hmm.
If your numerator is more, that means your gearing is more. That means the people who have given you loan are just surrounding you. Okay? So
Okay.
you are at a risky business. Okay. Take 5 minutes time, write down the solvency ratios, and then we go to investment ratio. So you have 5 investment ratios. Your
Hmm.
first investment ratio would be your earning per share. That means
Okay.
how much every share is earning. Okay. Now remember, when I'm talking about what the share is earning, I'm only talking about the ordinary shares.
Okay.
Because preference shares are going to be paid a fixed rate of dividend.
Hmm.
So whenever I'm looking at dividend yield ratio, dividend cover ratio, or dividend per share, we are only talking about ordinary shares.
Yeah. Okay.
Okay. So what are the ordinary share earning profit for the year? whatever is the profit for the year, from that you were going to minus the preference dividend.
Yeah.
Okay, divided by the number of shares, you will get how much each share is earning. Are you with me?
Yeah.
Okay, price earning ratio. Price earning ratio tells you that what price you are paying for the share, is it appropriate as per the market price? Okay, see now what is the price earning ratio? Suppose a share whose market price is 10
Huh.
and it is giving you an earning of 20.
Okay.
The price earning ratio is 0.5.
Oh, okay, like that, huh?
Okay, or it is giving you 50%.
Hmm.
Okay, so your price earning ratio tells you that the price that you are paying, is it fair enough when you are comparing it to your earning per share.
Yeah, got it.
Okay, so what is the formula for price earning ratio?
Price earning ratio is the price of the share and the earnings per share.
Which price of which share?
Ordinary share.
So price earning ratio would be price of which share? Market price. See,
Yeah, market price and
a share can have two price. Okay, it
huh.
has market price, it has the nominal price. Market price
Yeah.
is the price at which it is sold.
Hmm.
Okay, so market price per share divided by earning per share. So your price earning ratio is so many times. Market
Yeah.
price is say 10 and your earning per share
Like
is 50.
50. Hmm.
So 1 point divided by 5 is how much?
One must wait, I have to do, I don't know so much. 0.2.
0.2. That means even if your earning per share is 50, your shareholders do not look very confident on you. Why?
Because it's less, it's
Because the
0.2.
market price is very less compared to the earning per share.
Yeah.
Okay. Now let's take another example. Your market price per share is 1000, but your
Hmm.
earning per share is 1.
Yeah.
That means your price earning ratio is 1000 times.
Yeah.
Okay. The price of the share is 1000 times of what you are earning.
Okay.
What does this mean?
It's good, na? No, it's less. Sorry, it's bad.
Why bad?
Because, one second. No, it's better because it's like, yeah, I just read this. The larger, the better. It calculates how much
No,
market
no,
price
no.
is.
Understand one thing.
Hmm.
Why will someone give you a lot of money even though you're earning very less and giving him back?
Because future mein they can see.
Because the shareholders have confidence in the company. The shareholders feel that even if the company is earning less and giving me
Yeah.
right now, but it is using the money and it is expanding the business.
Okay.
So the price earning ratio is 1000 times. It is more. That means the market price is overvalued
Yeah, okay.
compared to what the return the company is giving. It tells us that the shareholders have a lot of confidence
Hmm.
in the company.
Okay.
Okay, let's take this with another example. I will take one lecture in a month
Hmm.
and I'm charging 10,000
Okay.
per month. Okay, I
Hmm.
am taking one lecture in a month. That means your earning that you're getting is only one and you're
Yeah.
paying me 10,000.
Yeah.
So your price earning ratio is 10,000 times.
10,000. Yeah.
Okay, at the same time, there is another person who is charging 1,000
Hmm.
and is taking 100 lectures.
Okay.
Okay, or let's make it more practical. He's charging 1,000 and he's taking 10 lectures.
Huh.
So
This will
100
be 100
times.
times. Yeah.
Okay, so come on, tell me whose students are more confident.
The one lecture one.
Okay, so these people are ready to pay this much because they have confidence in their future performance with this company.
Yeah, because that one lecture can be more efficient than that 10 lecture.
And here, the lower it is, the shareholders are still not confident with the company.
Yeah.
Okay, so we did two ratios. What was the two ratio? First ratio was what?
Earnings per share.
Hmm?
Earnings per share, and then the second one was price earnings ratio.
Okay, what is the formula for earning per share?
Profit for the year upon number of shares issued, ordinary shares issued.
And price earning ratio?
Price earning ratio is market price per share upon earnings per share.
So more the better
Better.
because the shareholders are confident.
Yeah.
Now, what is annual ordinary dividend? Dividend,
Annual.
whenever you have annual ordinary dividend, it is interim dividend plus proposed dividend of the same year.
Yeah.
Okay. Sometimes
Hmm.
they might give you proposed dividend of the previous year, but that you should avoid.
Okay.
Now you have another ratio which is called the dividend yield ratio.
Hmm.
Before you go to the dividend yield ratio, I want you to write two formulas for yourself. And
Yeah,
what
1 minute.
when I talk about the interest coverage ratio, it tells us profit can cover interest how many times.
Yeah.
When I talk about dividend cover ratio, then what will I say?
That how many times can the profit cover the
Profit can
dividend?
cover dividend how many times? Profit can pay
Yeah.
dividend how many times?
Yeah.
So which dividend we are talking about? Annual ordinary dividend.
Yeah.
Annual ordinary dividend means what?
Annual ordinary dividend is the like total final dividend plus interim dividend.
Interim dividend plus preference plus a final dividend and both of
Hmm.
the current year.
Yeah.
Okay. So dividend cover ratio will tell you profit can pay dividend how many times.
Yeah.
But which profit?
The profit like for the year.
Profit for the year. But you will
Hmm.
take the full amount of profit.
Not
Profit
full.
available to pay dividend.
Yeah,
Now,
how
what is
much?
the profit that is available to pay dividend? From the profit, you will first minus the preference dividend.
Yeah.
From the profit, when you first minus the preference dividend, you're going to get the profit that is available to pay the ordinary shareholders.
Hmm.
Okay. So, dividend cover ratio, what does it tell you?
The profit that is available to pay the dividend.
Now, what does dividend cover ratio tell you?
Oh, the number of times that the like how many times can you pay dividend if it's enough to pay dividend
Out
or
of your
no?
profits.
Yeah, out of the
What does the
profits.
interest cover ratio tell you?
That how many times you can pay the interest out of the profit.
What is the formula for dividend cover ratio?
The formula is profit for the year that is available to pay dividend upon annual ordinary dividend.
So, what is the profit that is available to pay dividend?
Profit minus preference dividend.
Profit minus preference dividend. Very good. So, now earning per share. What is the formula for earning per share?
Earning per share is market price per share upon earnings per share.
What nonsense.
Sorry, that's price earnings. I got confused. It's profit for the year upon number of issued ordinary shares.
What is price earning ratio?
Market price per share upon earnings per share.
What does the price earning ratio tell you?
The price earning ratio tells that if it's like the more it is, the better, basically.
Why?
Because the investors have future confidence in the business that it's going to do better.
Okay, fine. What is annual ordinary dividend?
Annual ordinary dividend is interim dividend plus final dividend.
What is dividend cover ratio tell you?
Dividend cover ratio tells if the profit that is available to pay the dividend can pay the dividend, like if we'll cover enough.
What is the formula for price earning ratio?
Market price per share upon earnings per share.
Okay. Now we talk about dividend yield ratio and dividend per share. Dividend per share would be very easy.
Annual ordinary dividend upon number of
Dividend
shares.
divided by shares.
Yeah.
Dividend divided by shares.
Shares.
Okay. This you can take total dividend divided by total number of shares. You get dividend per share. Okay, now dividend yield ratio. Dividend yield ratio, you get the dividend per share divided by the market price per share.
Okay.
Okay, dividend per share divided by market price per share. So this ratio tells you the returns the shareholders are getting based on the
Yeah.
market price. So based on the market price, what is the return that the shareholders are getting? Dividend yield. Dividend yield. Yield is return. Okay. So the shareholders are actually paying the market price.
Yeah.
So this they are paying and they are getting this return. So what is the formula for dividend yield ratio?
Annual ordinary dividend price
Dividend per share
dividend
divided by market price per share.
into 100. Okay.
Into 100. If your market price is 100 and dividend per share is 10,
Yeah.
that means you're getting 10% return.
10%, which is good or bad?
That depends depending upon the other companies how much return you're getting.
Yeah, also you have to compare it, so the bigger the figure, the better.
So whenever an investor is investing money, he will always look at the dividend yield ratio.
Yeah.
Dividend compared to the market price. He will always look at the dividend yield ratio, dividend compared to the market price into 100. So with this, there are 5 investment ratios. I want you to think about the 5 investment ratios and try to write it. Okay,
Okay.
this is a total summary of all the A level ratios.